There's a pattern in history that has destroyed three major financial systems in the last 700 years. And right now in 2025, the United States banking system is following that exact same pattern stage by stage, innovation by innovation, almost like we're reading from the same script that led to catastrophe every single time before. In 1340, the Medici Bank was the most powerful financial institution in Europe. They financed kings, controlled trade routes, and dominated international banking. Within 6 years, they collapsed completely and took half of Europe's economy with them. In 1637, the Dutch Republic had created the world's most sophisticated financial markets. Futures contracts, options trading, margin lending, all innovations. The tulip market crashed in February 1637 and the entire system imploded in 3 months. In 1720, England's South Sea Company was valued at more than all the gold in Europe. The stock was backed by government guarantees and held by everyone from dukes to shopkeepers. By September 1720, it was worthless and Britain's banking system was destroyed. 3 times. 3 financial innovations. 3 complete collapses, all following the exact same 5-stage sequence. And here's what should terrify you. The United States has already completed 3 of the 5 stages. We're not approaching the crisis. We're in stage 3 right now. Risk denial. This is the story of how banking systems die, why they always think they're different, and why the math says we're next. And it's happening faster than anyone in power wants to admit. Before we go through the pattern, you need to understand what a banking crisis actually is. Not a recession, not a market correction, total systemic collapse. A banking crisis happens when the financial system that everyone depends on suddenly stops working. Not because of war or natural disaster, because of mathematics. Because the debts exceed the assets. Because the leverage is unsustainable. Because everyone realizes simultaneously that the money they thought existed doesn't exist. Banks don't hold your deposits in a vault. They lend them out. They take your $100 and lend $900 against it. That works as long as everyone doesn't want their money back at the same time. But when they do, when confidence breaks, when people realize the system is fractional, the entire structure collapses. Not gradually, instantly. And the pattern is always the same. First comes financial innovation. Some new instrument, some new market, some new way to create leverage. It starts small. The innovators make fortunes. Others notice. Everyone wants in. The innovation spreads. Stage 2, leverage expansion. As more people participate, more money flows in. Asset prices rise. Rising prices justify more lending. More lending creates more money. More money chases assets. Prices rise further. It's a feedback loop. And everyone involved believes it will continue forever. Stage 3, risk denial. At this point, the mathematics say collapse is inevitable. The debt levels are unsustainable. The leverage ratios are impossible. The asset prices are detached from reality. But nobody wants to believe it. The innovators are rich. The regulators are captured. The politicians are benefiting. Everyone has incentive to pretend it's fine. Stage 4, liquidity crisis. Something breaks. A default, a scandal, a shock. Suddenly, someone needs cash immediately. They try to sell assets. But everyone else is doing the same thing. Asset prices collapse. Banks that looked solvent yesterday are insolvent today. Stage 5, total collapse. The banking system freezes. Credit stops. Trade halts. The real economy implodes. Governments step in, but it's too late. The damage is done. Wealth is destroyed. Savings evaporate. And the cycle starts over. This isn't theory. This is pattern recognition across 700 years. Let me show you how it happened 3 times before and why it's happening again right now. Let's start with the first modern banking crisis. Florence, Italy, 1340s. The Medici Bank and the Bardi-Peruzzi collapse. In the 1300s, Florence was the financial center of Europe. Not because of military power, because of banking innovation. Florentine bankers created a system that changed everything. Before Florence, lending was local. A merchant in London borrowed from a London moneylender. Simple, small scale, limited risk. But Florentine banks created something new: international branch banking. They had offices in every major European city: London, Paris, Bruges, Naples, Avignon. A merchant in London could borrow from the Florentine branch and repay in Paris. The bank transferred the debt internally. No physical gold needed to move. This was revolutionary. It enabled international trade on a scale never seen before. And two families dominated this system: the Bardi and the Peruzzi. By 1340, these two banks controlled more wealth than entire kingdoms. They financed the wool trade between England and Flanders. They collected papal taxes across Europe. They lent to kings. And that's where the pattern begins. Stage 1: Innovation Boom. The innovation was international branch banking. It solved a real problem. Moving gold across Europe was dangerous and expensive. Internal bank transfers were safe and cheap. The innovation worked. Trade expanded. The banks made fortunes. Everyone wanted to participate. By 1330, the Bardi and Peruzzi were lending massive sums to King Edward III of England. He was fighting the 100 Years' War against France. Wars are expensive. He needed constant funding. The banks provided it. Why? Because a king's debt was considered safe. Kings had tax revenue. They controlled territory. They could always repay. That was the theory. Stage 2: Leverage expansion. Here's what nobody explains about medieval banking. The Bardi and Peruzzi didn't have enough capital to fund Edward's war directly. So they borrowed from depositors. Merchants, nobles, churches, anyone with excess gold deposited it with the banks for safekeeping. The banks paid interest, maybe 5% annually. Then they lent that gold to Edward at 15% to 20%. The spread was profit. But here's the critical detail. They lent the same gold multiple times. Fractional reserve banking. A depositor puts in 100 florins. The bank keeps 10 in reserve and lends out 90. That borrower spends the 90 florins. The recipient deposits it in another Florentine bank. That bank keeps 9 in reserve and lends out 81. The original 100 florins has now created 271 florins of circulating credit. This is how banks create money. And in 1330, it was brand new. The leverage ratios were extraordinary. The Bardi Bank had capital of about 875,000 florins but outstanding loans of 1.7 million florins. Nearly 2-to-1 leverage. The Peruzzi Bank had capital of 680,000 florins but loans of 1.4 million florins. Over 2-to-1 leverage. By modern standards, that seems conservative. By 1330 standards, it was insane. And most of their loans were to one borrower: King Edward III. Stage 3: Risk denial. By 1338, Edward owed the Bardi and Peruzzi a combined 1.5 million florins. That's over 900 million in today's purchasing power. And he wasn't paying. The war was going badly. England's tax revenue was insufficient. Edward kept promising repayment, kept borrowing more, kept defaulting on interest. The banks kept lending. Why? Because admitting the loans were bad would mean admitting insolvency. As long as Edward's debt was marked as good, the bank's balance sheets looked healthy. As long as the balance sheets looked healthy, depositors kept their gold in the banks. As long as depositors kept their gold in the banks, the system continued. This is risk denial. Everyone knows the debt won't be repaid. But acknowledging it means collapse. So nobody acknowledges it. The Florentine banking community knew Edward was finished. The wool trade numbers showed it. The tax collection reports showed it. But the banks kept the loans marked as performing. They kept issuing dividends to shareholders. They kept accepting deposits. Stage 4: Liquidity crisis. In 1340, Edward declared he would not repay his debts. Not delayed repayment, outright default. 1.5 million florins gone. The Bardi and Peruzzi tried to absorb the loss quietly. They couldn't. Word spread. Depositors started withdrawing gold. The banks didn't have it. They'd lent it to Edward. They tried to call in other loans to raise cash. But everyone else was doing the same thing. Asset prices collapsed. Loans they thought were worth face value were suddenly worth 50%, then 30%, then nothing. By 1343, the Bardi Bank was bankrupt. By 1346, the Peruzzi Bank was bankrupt. Stage 5, total collapse. When the Bardi and Peruzzi fell, they took the entire Florentine banking system with them. Dozens of smaller banks had lent to the Bardi and Peruzzi. When those loans defaulted, the smaller banks failed. Depositors across Europe lost their savings. Merchants couldn't get credit. Trade contracted. The wool industry collapsed. Unemployment exploded. Florence, the richest city in Europe, descended into poverty. And here's the critical lesson. The collapse wasn't caused by war or plague or external shock. It was caused by leverage. The banks created money that didn't exist. They lent it to a borrower who couldn't repay. And when reality caught up with fantasy, the system imploded. The Medici Bank rose from the ashes in 1397, 57 years later. They learned nothing. Within 150 years, they repeated the exact same pattern and collapsed the exact same way. Let's jump forward 300 years. The Dutch Republic, 1630s. Tulip mania and the first modern futures market. In the 1600s, the Dutch Republic was the richest place on earth. They'd broken free from Spanish rule. They controlled global trade. The Dutch East India Company was the most valuable company in history. Amsterdam was the financial capital of the world. And Dutch bankers created a new innovation: futures contracts and margin trading. Here's how it worked before the Dutch innovation. If you wanted to buy something, you paid cash immediately. If you wanted to sell something, you delivered it immediately. Simple, direct, limited. But the Dutch created paper contracts for future delivery. You could agree in January to buy tulip bulbs in June at a fixed price. You didn't pay in January. You paid in June when the bulbs were delivered. This was brilliant for merchants. Tulip growers could sell their entire crop before planting. Buyers could lock in prices before harvest. Everyone reduced risk. The innovation worked. Stage 1, Innovation Boom. Tulips had been introduced to Europe from Turkey in the 1550s. They were exotic, beautiful, and rare. Wealthy Dutch merchants collected them. By 1630, tulip breeding had created new varieties. Striped petals, unusual colors, unique patterns. The rare varieties commanded high prices. Not because they were useful, because they were status symbols. Owning a rare tulip meant you were wealthy. And here's where the futures market changed everything. Instead of buying actual tulip bulbs, people started buying futures contracts. You could buy a contract for a Semper Augustus tulip for delivery next June. You didn't need the cash now. You'd pay in June. But the contract itself could be sold. If the price rose, you could sell the contract at a profit without ever touching an actual tulip. This was speculation. Pure paper profits. Stage 2, Leverage Expansion. By 1636, tulip futures were being traded in taverns across Holland. Not just wealthy merchants, everyone. Weavers, carpenters, farmers. People who had never invested in anything were buying tulip contracts. And here's the leverage mechanism. You could buy a futures contract with a small deposit. Maybe 10% down. So a contract worth 1,000 guilders required only 100 guilders upfront. You controlled 1,000 guilders of value with 100 guilders of capital. 10-to-1 leverage. If the price rose to 1,500 guilders, you made 500 guilders profit on 100 guilders invested. 500% return. People sold their houses to buy tulip contracts. They mortgaged their businesses. They borrowed from everyone they knew. Because the prices kept rising. And rising prices justified more borrowing. More borrowing created more demand. More demand pushed prices higher. By January 1637, a single Semper Augustus tulip bulb was worth 6,000 guilders. That's more than 10 times the annual income of a skilled craftsman. One flower bulb. At the peak, the total value of tulip contracts exceeded the entire GDP of the Dutch Republic. Most of it was leverage. Money that didn't exist betting on future prices that couldn't be sustained. Stage 3. Risk denial. By January 1637, everyone involved knew the prices were insane. A tulip bulb isn't worth more than a house. It produces no income. It has no industrial use. It's a flower. But nobody wanted to be the first to sell. Because selling meant admitting it was over. And as long as everyone kept buying, prices kept rising. The tavern traders developed elaborate justifications. Tulips were rare. Breeding took years. Demand was growing internationally. The Dutch were masters of horticulture. The prices reflected future value. All nonsense. But profitable nonsense, so everyone believed it. Stage 4. Liquidity crisis. In February 1637, a tulip auction in Haarlem failed. A batch of bulbs received no bids. Not lower bids, no bids. Word spread instantly. If those bulbs couldn't sell, what were they worth? Suddenly, everyone wanted to sell their contracts simultaneously. But futures contracts require a buyer. When everyone is selling and nobody is buying, there are no transactions. The market froze. Within a week, tulip contract prices collapsed by 95%. People who owned contracts worth 10,000 guilders on Monday owned paper worth 500 guilders on Friday. And they still owed the balance. Remember, most people bought on margin. They'd put down 10% and owed 90%. If you bought a contract for 10,000 guilders with 1,000 down, and it's now worth 500 guilders, you still owe 9,000 guilders. You lost your deposit and you're in debt. Stage 5. Total collapse. The tulip crash destroyed the Dutch credit market. Thousands of people defaulted on debts they couldn't pay. Lenders who thought they had good loans suddenly had nothing. Those lenders couldn't repay their lenders. The cascade spread. Banks failed. Merchant houses failed. Trade credit disappeared. And here's what most people don't understand about tulip mania. The real damage wasn't the tulip losses. It was the credit implosion. The Dutch economy ran on trust. Merchants extended credit to each other. Bills of exchange circulated as currency. When the tulip defaults destroyed trust, the credit system froze. Legitimate businesses couldn't get financing. Trade contracted. The richest economy in Europe entered a depression. The Dutch Republic recovered, but it took decades. And they learned nothing. By the 1700s, they were inflating new bubbles and other assets. The pattern repeated. Let's jump forward 80 years. England, 1720. The South Sea Bubble. This is the third example, and it's the most relevant to today because it involved government debt, complex financial engineering, and a company that was too big to fail. In 1720, England had a problem. The government owed £31 million from the War of Spanish Succession. That's over $5 billion in today's money. The interest payments were consuming half the government budget. Something had to be done. The South Sea Company proposed a solution. They would assume the government debt. All £31 million. In exchange, the government would grant them a monopoly on trade with South America and pay them an annual fee. The bondholders would exchange their government bonds for South Sea Company stock. Everyone wins. The government reduces debt. The bondholders get stock in a profitable trading company. The South Sea Company gets the monopoly and the annual fee. Parliament approved the scheme in 1719. Stage 1. Innovation boom. The innovation was debt for equity conversion. Instead of owing creditors money, the government would owe them nothing. The creditors would own shares in a private company. The company would manage the debt and profit from the trading monopoly. This was financial engineering at a level England had never seen. And here's where it gets interesting. The South Sea Company had almost no actual trade with South America. Spain controlled South America. England had limited access. The company's real asset was the government's annual payment and the promise of future profits. But that didn't matter. What mattered was the stock price. If the stock price rose, bondholders would eagerly exchange their bonds for shares. The company would assume more debt. The government would be happy. Everyone would get rich. So the South Sea Company focused on one thing: driving the stock price up. Stage 2: Leverage expansion. The South Sea Company started promoting their stock aggressively. They published pamphlets about the vast wealth of South America. They announced partnerships that didn't exist. They paid bribes to politicians and newspapers. And most importantly, they offered loans to buy South Sea stock. You could borrow money from the South Sea Company to buy South Sea stock. They'd lend you 80% of the purchase price. You put down 20%. If the stock doubled, you made 10 times your investment. This is leverage. And it's insane. The company was lending money backed by their own stock to buy their own stock. As long as the price rose, it worked. The loans looked good. The collateral looked solid. More buyers meant higher prices. Higher prices meant more buyers. In January 1720, South Sea stock traded at £128 per share. By May 1720, £550 per share. By June, £1,000 per share. Nearly 8 times increase in 6 months. The entire English aristocracy bought in. Dukes, earls, members of parliament. Isaac Newton bought in. He later said, "I can calculate the motion of heavenly bodies, but not the madness of people." Even the king owned shares. The South Sea Company was the government. The government was the South Sea Company. It was too big to fail. Stage 3: Risk denial. By June 1720, everyone rational knew it was a fraud. The South Sea Company had no trade. They had no ships in South America. They had no profits. Their revenue was the government's annual payment and stock sales. They were paying dividends with money from new investors. It was a Ponzi scheme. But nobody wanted to say it. Because everyone was making money. The original investors had 8x returns. The politicians who approved the scheme owned stock. The newspapers taking advertising money promoted it. The king's wealth depended on it. And here's the key. The government's debt reduction depended on the stock price staying high. If the stock collapsed, the bondholders wouldn't convert. The debt would remain. The scheme would fail. So the government had every incentive to keep the bubble inflating. They passed a law banning competing investment schemes. They arrested promoters of rival companies. They protected the South Sea Company from competition. Because the government was all in. Stage 4: Liquidity crisis. In August 1720, some insiders started selling. Quietly, in large blocks. Word leaked. Other insiders sold. The selling accelerated. By September, the stock was in free fall. £1,000 in June. £175 in September. 90% crash in 3 months. And remember, most people bought on margin. They borrowed from the South Sea Company to buy stock. The stock was collateral. When the stock crashed, the loans were under-collateralized. The company demanded repayment. The borrowers didn't have cash. They tried to sell their shares. But everyone was selling. The market had no buyers. Stage 5: Total collapse. The South Sea collapse destroyed England's financial system. Thousands of families lost everything. Aristocrats who were wealthy in June were bankrupt by October. Banks that lent against South Sea stock failed. Merchants who accepted South Sea shares as payment held worthless paper. Credit disappeared. Trade halted. The government tried to bail out the company. Impossible. The debt was too large. The losses were too widespread. They investigated and found massive fraud. Directors were arrested. Assets were seized. But the money was gone. You can't seize money that was never real. And here's the critical lesson. The South Sea Company was backed by the government. It had a legal monopoly. It was the official solution to government debt. It was too big to fail. And it failed completely. Because mathematics doesn't care about official backing. When the leverage is unsustainable, collapse is inevitable. England recovered, but it took decades. The South Sea Company limped on until 1853, a shell. And the pattern was ready to repeat. Now let's look at the modern example. The United States, 2000 to 2025. This is the fourth test and we're in stage 3 right now. In the 1990s, the United States deregulated the financial industry. The Glass-Steagall Act, which separated commercial banking from investment banking since 1933, was repealed in 1999. Banks were now free to do everything. Take deposits, make loans, trade securities, underwrite offerings, speculate with derivatives. And they created new innovations. Mortgage-backed securities, collateralized debt obligations, credit default swaps. Financial products so complex that even the people selling them didn't understand them. Stage 1, Innovation Boom. The innovation was securitization. Here's how it worked. A bank makes a mortgage loan. Instead of holding the loan until repayment, they bundle it with 1,000 other mortgages. They sell the bundle to investors as a mortgage-backed security. The investors receive the monthly payments. The bank receives cash immediately. The bank uses that cash to make more mortgages. Those mortgages are bundled and sold. More cash. More mortgages. The cycle repeats. This was brilliant. It turned illiquid loans into liquid securities. It spread risk across thousands of investors. It enabled banks to lend far more than their deposits allowed. The innovation worked. The housing market boomed. Banks made fortunes. Everyone wanted in. Stage 2, Leverage Expansion. By 2005, securitization had gone insane. Banks weren't just bundling prime mortgages. They were bundling subprime mortgages. Loans to people with no income verification. No down payment. Adjustable rates that would explode in 2 years. Why did banks make these terrible loans? Because they weren't holding them. They were selling them immediately. As long as investors bought the securities, banks kept making loans. And the investors? They didn't know what they were buying. The mortgage bundles were sliced into tranches. AAA-rated senior tranches. BBB-rated mezzanine tranches. Unrated equity tranches. Rating agencies gave AAA ratings to securities backed by subprime mortgages. How? Through models that assumed housing prices would rise forever. If prices rise, even bad borrowers can refinance. No defaults, no problem. The models were garbage. But they justified the ratings. The ratings justified the investments. Pension funds, insurance companies, foreign banks, everyone bought mortgage-backed securities. And here's the leverage mechanism. Banks didn't just sell the securities. They kept some and borrowed against them. A bank would hold $1 billion in mortgage-backed securities rated AAA. They'd borrow $950 million against them. Use that $950 million to buy more securities. Borrow $900 million against those. Use that to buy more. 30-to-1 leverage was common. Some investment banks hit 40-to-1. That means a 3% decline in asset values wipes out all capital. Total insolvency. But the model said it was safe. AAA-rated securities never declined 3%. Except when they do. And it wasn't just mortgages. The banks created credit default swaps. Insurance contracts against defaults. If you owned a bond and worried about default, you bought a swap. The seller collected premiums and paid out if the bond defaulted. It was insurance, but unregulated. Insurance companies must hold reserves. Swap sellers didn't. AIG, the largest insurance company in America, sold hundreds of billions in credit default swaps. They collected premiums. They paid no claims because defaults were rare. The profits were pure. And they held almost no reserves. Why? Because the model said the risk was minimal? The models were wrong. By 2007, the U.S. financial system had created $600 trillion in derivatives. That's 10 times global GDP. Most of it was leverage. Bets on bets on bets. Money that didn't exist betting on outcomes that couldn't be hedged. And everyone involved thought they were safe. Because the model said so. Stage 3, Risk Denial. By 2006, everyone rational knew it was unsustainable. Housing prices were detached from incomes. Mortgage defaults were rising. Subprime lenders were failing. But nobody in power acknowledged it. The banks were making record profits. Wall Street bonuses were astronomical. The rating agencies were getting paid for every security they rated. The regulators were former bank executives who'd returned to banking after government service. Everyone had incentive to pretend it was fine. And here's what's critical. The government was complicit. Homeownership was policy. The government wanted more Americans to own homes. They encouraged loose lending. They backed Fannie Mae and Freddie Mac, which bought mortgages from banks. They provided implicit guarantees. If the housing market collapsed, the government would have to step in. Everyone knew it. So everyone assumed the risk was socialized. Banks could profit. Losses would be covered. This is moral hazard. When you have profits without risk, you take maximum risk. By 2007, every major bank was leveraged 30 to 1 or more. Their model said it was safe. Their regulators approved it. Their shareholders demanded it. Nobody wanted to be the first to pull back. Because pulling back meant missing profits while competitors gained. Better to ride the wave and hope it doesn't crash on your watch. Stage 4, Liquidity Crisis. In 2007, housing prices started falling. Not crashing, just declining. 5%, then 10%. Mortgage defaults rose. Borrowers with adjustable rate mortgages couldn't make payments when rates reset. They couldn't refinance because their homes were underwater. They defaulted. The defaults started showing up in mortgage-backed securities. The AAA-rated tranches started taking losses. Rating agencies downgraded them. Investors panicked. Nobody wanted mortgage-backed securities anymore. Banks tried to sell them. No buyers. The securities were marked at 100% of face value on bank balance sheets. But they couldn't be sold at any price. Mark-to-market accounting forced banks to write down values. 100 became 80. Then 60. Then 40. Banks that looked solvent in January were insolvent by July. Their capital was gone. Their assets were worth less than their liabilities. Bear Stearns collapsed in March 2008. The government forced a sale to J.P. Morgan. Lehman Brothers collapsed in September 2008. The government refused to bail them out. The bankruptcy was the largest in history. $600 billion in assets, gone. And here's what triggered total panic. Lehman Brothers was a counterparty to thousands of other financial institutions. When they failed, everyone who had traded with them lost money. Credit default swaps Lehman had sold became worthless. Derivatives Lehman had bought couldn't be honored. Counterparty risk exploded. Nobody trusted anyone. If Lehman could fail, anyone could fail. Stage 5, Total Collapse. In September 2008, the global financial system came within hours of complete shutdown. Money market funds broke the buck. Commercial paper markets froze. Interbank lending stopped. Banks wouldn't lend to each other overnight. Not at high interest rates, at any rate. Trust was gone. The Federal Reserve opened emergency lending facilities. They lent directly to banks, to broker-dealers, to money market funds, to anyone who needed cash. The Treasury Department seized Fannie Mae and Freddie Mac. They bailed out AIG with $182 billion. Congress passed TARP, the Troubled Asset Relief Program. $700 billion to buy bad assets from banks. The government went all in. And it worked barely. The system didn't completely collapse. But the damage was catastrophic. 8 million Americans lost jobs. 10 million lost homes. 19 trillion in household wealth evaporated. The government added 10 trillion in debt. And here's what's critical. Nothing was fixed. The banks that caused the crisis got bigger. J.P. Morgan bought Bear Stearns and Washington Mutual. Bank of America bought Merrill Lynch and Countrywide. Wells Fargo bought Wachovia. The system became more concentrated. More too big to fail. The regulations passed were cosmetic. Dodd-Frank added paperwork but didn't end leverage. Banks still operate with 10 to 1, 15 to 1 leverage. The derivatives market is now $1 quadrillion. Shadow banking, non-bank financial institutions doing bank activities without regulation, is larger than ever. And the next crisis is being built right now. Let me show you where we are in the pattern. Stage 1, Innovation Boom, 1990 to 2000. The innovation was securitization and derivatives. It solved a real problem. It enabled more lending and risk distribution. The innovation worked. The economy boomed. Stage 2, Leverage Expansion, 2000 to 2007. Banks created massive leverage through securitization, derivatives, and off-balance sheet vehicles. Asset prices inflated. Debt exploded. Everyone participated. Stage 3, Risk Denial, 2007 to 2008. Everyone rational knew it was unsustainable. The warnings were everywhere. Nobody in power acknowledged it until collapse was underway. Stage 4, Liquidity Crisis, 2008. The market froze. Assets couldn't be sold. Banks became insolvent. Credit disappeared. Stage 5, Total Collapse, 2008 to 2009. The government intervened. They prevented complete collapse. But they didn't fix the system. They made it bigger. More concentrated. More leveraged. More unstable. And that's where we are now. 2025, Stage 3 of the next cycle. The innovations this time are different. Leveraged loans. Private equity. CLOs, collateralized loan obligations. ETFs, exchange-traded funds. Algorithmic trading. Cryptocurrency derivatives. All the same mechanisms as 2008. Different names. Same leverage. Same risk. Same denial. Here's the current state. U.S. banks hold $2.3 trillion in commercial real estate loans. Office buildings are empty. Remote work is permanent. Valuations have dropped 30% to 50%. The loans are marked at face value. Nobody is writing them down. Not yet. Private equity firms have raised $3 trillion in dry powder. They've bought thousands of companies using leverage. 6 to 1, 8 to 1, 10 to 1 debt-to-equity ratios. The companies are loaded with debt. Interest rates are up. Refinancing is impossible for many. Defaults are starting. The private equity firms will lose their equity. The lenders will lose their loans. CLOs, which bundle these leveraged loans, are rated AAA. Just like mortgage-backed securities in 2007. The models say they're safe. The models are wrong. Shadow banking, institutions that act like banks but aren't regulated as banks, now controls $250 trillion in assets. That's 3 times the size of the regulated banking system. They have massive leverage. Minimal reserves. No lender of last resort. When they freeze, the entire credit system freezes. Cryptocurrency derivatives have exploded. Futures, options, perpetual swaps. Exchanges offer 100 to 1 leverage. You can control $100,000 of Bitcoin with $1,000. Billions in daily trading volume. No regulation. No clearinghouse guarantees. When a crypto exchange fails, it just disappears. Billions gone. No recourse. This is stage 3. Risk denial. Everyone in finance knows these risks exist. The IMF publishes reports. The BIS issues warnings. Academic economists write papers. But nobody in power acts. Because acting means popping the bubble. Popping the bubble means recession. Recession means political pain. Politicians don't cause recessions voluntarily. They wait until crisis forces action. By then, it's too late. The banks know the commercial real estate loans are bad. They're not writing them down because that would require raising capital. Raising capital would dilute shareholders. Shareholders would punish the stock price. Better to extend and pretend. Kick the can. Hope something changes. The private equity firms know their portfolio companies are overleveraged. They're not marking down values because that would show losses. Losses would hurt their ability to raise new funds. Better to claim everything is fine. The shadow banks know they're vulnerable. They're not reducing leverage because that would reduce returns. Lower returns mean investors leave. Better to keep the leverage and hope rates don't rise further. The crypto exchanges know they're operating on the edge. They're not implementing proper risk controls because that would limit trading volume. Lower volume means lower fees. Better to maximize now and deal with problems later. This is risk denial. And it's happening right now. We're not approaching stage 4. We're in stage 3 waiting for the trigger. What will the trigger be this time? Maybe commercial real estate. A major office tower defaults. The loan is written down. Other loans are examined. Billions in write-downs cascade through the system. Maybe private equity. A wave of leveraged buyouts from 2019 to 2021 need refinancing. Interest rates are 3% higher. The companies can't afford the new debt service. Defaults spread. CLOs collapse. Maybe shadow banking. A major non-bank lender freezes. They can't roll their short-term funding. They're forced to sell assets. Asset prices crash. Other shadow banks face the same problem. The cascade begins. Maybe crypto. A major exchange fails. Billions in customer funds disappear. Regulators crack down. Leverage is banned. The crypto derivatives market implodes. Contagion spreads to traditional finance. Maybe something else. A geopolitical shock. A pandemic. A cyber attack. Something that stresses the system just enough to expose the leverage. The trigger doesn't matter. The mathematics say stage 4 is coming. The only question is when and how fast. Let me show you the timeline comparison. Medici Bank, 1340. Stage 3, risk denial lasted 3 years. Stage 4, liquidity crisis lasted 2 years. Stage 5, total collapse took 3 years. Total time from risk denial to collapse, 8 years. Tulip mania, 1637. Stage 3 lasted 6 months. Stage 4 lasted 2 weeks. Stage 5 took 3 months. Total time, 9 months. South Sea Bubble, 1720. Stage 3 lasted 3 months. Stage 4 lasted 6 weeks. Stage 5 took 4 months. Total time, 8 months. 2008 financial crisis. Stage 3 lasted 18 months. Stage 4 lasted 6 months. Stage 5 took 12 months. Total time, 3 years. The pattern is accelerating. Each crisis moves faster than the last. Why? Because leverage is higher. Because systems are more connected. Because information spreads instantly. Because once confidence breaks, it breaks completely. And the current cycle? Stage 3 started around 2022. Commercial real estate problems were visible. Private equity stress was building. Shadow banking risks were clear. We're now 3 years in. If the pattern holds, Stage 4 could trigger any time in the next 12 to 24 months. Stage 5 would follow within 6 months after that. Total collapse by 2027 or 2028. Maybe sooner. 4 times. For financial innovations. For leverage expansions. For risk denials. For liquidity crises. For total collapses. All following the exact same 5-stage pattern. Medici Bank, Tulip Mania, South Sea Bubble, 2008 crisis. And right now, the United States is at stage 3 moving to stage 4. The commercial real estate losses are mounting. The private equity defaults are starting. The shadow banking leverage is extreme. The crypto derivatives are exploding. Most people don't see it. They think 2008 taught us lessons. They think regulators won't let it happen again. They think the system is safer now. That's what Florentine bankers thought after the Bardi collapse. That's what Dutch traders thought after tulip mania. That's what English investors thought after the South Sea Bubble. They were wrong every time. Because the pattern isn't about learning lessons. It's about human nature. Greed drives innovation. Innovation enables leverage. Leverage inflates bubbles. Bubbles create denial. Denial delays response. Response comes too late. Collapse is inevitable. The mathematics don't change. The psychology doesn't change. Only the names change. And this time, the collapse will be faster, more widespread, and more devastating than anything before. Because the leverage is global. Because the connections are instant. Because the system is more fragile than ever. The question isn't if it will collapse. The question is what triggers stage 4, and whether anyone will be ready when it does.